Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, September 3rd, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and it's certainly a pleasure to be with you. We'll be taking a look at some charts this morning, maybe for the next 30 minutes up until the stock market opens. It's September. I'm not sure whether to get upset or smile or what. We got some good things happening in the market, but obviously September is the month. It's the only calendar month where the S&P 500 has gone down more often than it's gone up since 1950. So I think over the last 73 years, I think we've gone up 33 times and down 40 times. So very unusual in that sense, and that many of the other months, we have some months like November, December, where we typically go up. I think over the last 70 some years, we've gone up like 50 times and gone down maybe 23 times. So clearly there's something about September. I think there's just a lot of things that come together personally. I think number one, it's the last month in a calendar quarter. So March, June, September, and then even December for some areas of the market like growth can be a little bit rough. So I think you got that dynamic going on, your past earnings season. So a lot of the great earnings or whatever has been built into the stock market. Earnings tend to go higher over time. And as a result, when you're going through earnings season, the market tends to go up. And then you get past earnings season and there's this lull. And I think it just maybe induces some selling and some sideways market action. As a result, we typically don't see the kind of bullish behavior during third calendar months of quarters like we do in the other couple of months. So I think that's maybe one theory there. I think also as you get closer to the end of the year, it's really tough for companies to kick the can further down the road. So for instance, in the first quarter, if they report earnings and the earnings aren't up to par, they can always say, yeah, but second quarter we think is going to be really good. And the rest of the year, we still have a really, bullish outlook on our business for the rest of the year. You get into the second quarter, and, they come out with the earnings. Well, first half of the year wasn't as good as we thought it would be, but man, second half of the year looks great. Everything should be good. We're really expecting a big second half. By the time you roll around to the third quarter, it's like, okay, maybe we just want to throw all of our dirty laundry in. If we're having a bad report anyway, let's just, anything that's potentially a loss, let's just throw it in there. Let's get it out of the way so that we can talk not only about the fourth quarter being better, but then next year. Then all of a sudden, well, next year is going to be a lot better. And so I don't know if there's something about September, I think as you get, toward the end of summer, that you just can't keep making excuses anymore. And I think the market punishes companies that maybe haven't lived up to expectations the way they thought they were going to. Just my theory. I think there's some psychology involved too, getting toward the end of summer. It's kind of like, going back to work on Mondays. I think there's a reason why Mondays are clearly underperforming days relative to the rest of the week. Tuesday's better. Wednesday, Thursday, Friday historically have been the three best days. Because why? Well, it's Monday. You just had a good weekend. Now you got to go back to work. And so I think there's a psychological component to that. And I think there's also a psychological component to September, where maybe, you've taken some vacations over the summer. You feel pretty good. Maybe you're a warm weather versus cold weather kind of person. I don't know. But I think there may be some considerations there anyway that maybe help define the market during the month of September. But anyway, August is over. So let's first take a look at what happened to end August. And so I'll pull my screen up here for you, try to get it a little closer. Everybody can see this, hopefully a little bit better. Anyway, Dow Jones Industrial Average finished the month up 228 points, and we finished at 41,563.08. Why is that important? Well, number one, it's the highest close the Dow Jones has ever seen. So we closed last week. We closed August at an all-time high on the Dow Jones. Now, that's pretty significant because recently we saw the volatility index skyrocket. Remember back at the beginning of August. So here we are at the end of August, sitting there with an all-time high on the Dow Jones. Beginning of August didn't look like we'd be talking about all-time highs by the end of the month on any index, right? We started off the 1st of August. That was the day after the Fed meeting. Immediately things started to turn down. It was like, I think right around 11 o'clock in the morning that morning, I wrote normally I do our daily market report to members in the afternoon, a lot of times later in the afternoon, because I like to see the action first before I write about it. But that morning was like, okay, things have really turned. So I actually sent out a DMR on August 1st at about 11 a.m. And in the title of the daily market report was warning in all caps. So that's how we started August. I was very, very concerned going into the beginning of August, coming out of that Fed meeting. And the way the market traded in the final hour on it was Wednesday, July 31st, after the 2 o'clock Fed announcement, we had to deal with, the first hour wasn't so bad, but the second hour, we started to see a lot of selling. A lot of those gains in the afternoon were given back. And then on Thursday, August 1st, we opened down, and the rotation was telling me, all these different areas of the market that were being bid up in anticipation of rate cuts. All of a sudden, they were reversing and badly lagging the rest of the market. So all of a sudden, Wall Street is saying, I don't know what's going on with this Fed, but we don't even trust that they're going to cut at this point. We need more information. So it was a sell first, worry about everything else later kind of scenario. And so that's why I sent out that warning on Thursday, August 1st. And you know what happened the rest of Thursday, you know what happened on Friday. And then, of course, the massive gap down on Monday. So there were definitely some, tea leaves worth reading back then. But since August 5th, things kind of started to settle back down again. It took a little while to get technology going, but then technology started kicking in. We saw some strength from semiconductors. And so August was this month of extreme fear at the very beginning after the Fed meeting, with the VIX shooting up into the 60s, which we haven't seen too many times. If you go back since the VIX was created back in the early 90s, we haven't really seen the VIX up in the 60s very often. I can probably count them on one hand. So it was one of those moments where the market was, ready to just make this massive drop to the downside because of the disappointment on Wall Street. And Monday came, we had the big gap down, and then cooler heads kind of prevailed, and things started to kind of slowly move back up until the end of the month. Like I'm saying, Dow Jones 228 points higher on Friday, all-time high. The VIX, it was up in the 60s. I'm not sure exactly where it finished, but I'll tell you here in 1 second. I know it was down in the 14s to around 15. And on Friday, we closed at 15. So that's a far cry from being in the 60s, right? So that's what we've had to deal with in August. So it was a horrible start, nice finish toward the end of the month. The S&P 500, as you can see, gaining 56 points on Friday. That's another 1%, and pretty close to an all-time high. Within, it's less than 1% away now. And that's, again, a far cry from where we were at the beginning of the month, talking about possible cyclical bear market, at least a correction. And then going from that to back near all-time highs on the S&P 500. So really good action, I think, the rest of August to kind of keep the bull market, the secular bull market alive, and not just alive, but on the verge on the S&P 500 anyway, of breaking to an all-time high. That's where we're starting September from. And we got some issues with September. We'll talk about that in just a little bit. Rounding out what happened at the end of August, we had the NASDAQ 100 gaining 249 points. That was 1.3%, getting back to 19.5. Look at the relative strength, though, on the NASDAQ. See how the NASDAQ still ways away, probably over 1,000, well, definitely over 1,000 points away from closing at its all-time high. S&P right on the doorstep. The Dow just did it. So clearly there's a little bit of rotation, maybe a little bit more than a little bit of rotation away from some of those key large cap growth names. So, we saw NVIDIA report earnings recently, and company gapped down, tried to come back a little bit intraday, and then went back down again. I mean, it's just doesn't feel quite the same as it did back before in terms of leadership. Now, that can be a bad thing, but it also can be a good thing. I think a lot of it comes down to what's going on with the rest of the indicators that I like to follow. And for the most part, my indicators remain bullish. Sentiment remains very bullish, in my view, the way I look at it. We've got divergences for the most part that look pretty bullish, especially the long-term monthly divergences. I mean, we're coming off centerline tests and literally pointing straight up. So we're gaining momentum as we move into the month of September. So there are some good things going on with this rotation. The good news is that when the money is falling out of areas like technology during the month of August, we haven't seen that leave the market. We've had it rotate. And some of the areas where it's rotated to, we've seen mid caps. Mid caps finished up 22.5 points on Friday, back up above. I mean, we're well above that 3,000 level. And 3150, you can see the recent high that we saw back at the end of July. That's not really that far out of our grasp. It's definitely closer than what we see on the NASDAQ, maybe not nearly as close as what we see on the S&P. But mid caps, big reaction since that August 5th low, coming all the way back up, gaining from that bottom, probably gaining 10% over the last 3 to 4 weeks of August. So we've seen that money, kind of disappear out of technology and some other key areas, but we are seeing it pick up in areas that had been lagging the market for a while. And we want this full participation. We want wide participation in a secular bull market. And we're beginning to see that in terms of breakouts. Absolute. I'm not talking about relative. I'm just talking about absolute breakouts in some areas. And we'll talk about that in just a few minutes. But mid caps still needing a little bit more work. Small caps up over almost 0.6%. IWM gaining over $1.27, back up above $220. Still a little bit to go to get that high, which was up over 228 at the end of July, but clearly in an uptrend off of that August 5th low, but not performing quite as well as the mid caps. Transports, I really love to see the transports coming back up, but this has been a series of ups and downs on the transports for the last year, maybe longer. So looks like we're about to break out, and then next thing you know, we're back down near the lows. And then we're about to break out, and we're back down near the lows. I mean, this whole chart you can see for the last 6 months has been pretty much just sideways. Sometimes it appears the bears are in control. Sometimes it looks like the bulls are in control. And quite honestly, nobody's in control. Transports are just sitting, waiting for a signal for a breakout. We're in a nice uptrend. So again, bulls look like they're in control, but it's September. What's going to happen? I don't know. We're all going to find out together. Let's go on, move down to the sectors. We got discretionary leading on Friday, gaining more than 1.5%. That's up $2.78. We got this, what looks to me to be like this head and shoulder type of bottom. The only problem is the bottom is the low of the last 6 months. So it's really not a bullish inversing or inverse, head and shoulder pattern where you have an uptrend and then you have a left shoulder, neckline, head, neckline, and then right shoulder, and then breakout. It looks like that, but off of an uptrend, that inverse head should not come down more than 50% of the uptrend. And here you can see not only is up more than 50%, it wiped out the entire uptrend and then some. So it's not that kind of a pattern that we can measure off of, but the pattern is still the same. I mean, we still have what I consider to be pretty significant resistance on the XLY, about that 188, 189 level. We got gap resistance, and then we've got 2 recent highs. Now, this is just short term because we're only talking about the last month and a half, maybe 2 months. But still, it's overhead resistance, and the XLY is going to have to negotiate that. But we're right now at least hanging above the 20-day moving average and heading in the right direction. Technology gaining 1.33%. So while it was a pretty rough month, second half of July started off to be rough. And then after the Fed meeting, we saw another big drop. We went down below the April low on the XLK. We didn't see that in the overall market, but we did see it in the most influential area of the market. So the only reason the overall market didn't go down there is why? Because money was rotating. We saw other areas of the market not seeing that kind of weakness. So part of this is a good thing because when you get your leader technology breaking down, a lot of times money just leaves the market if we're going to continue to go lower. In this case, we're seeing a lot of rotation, And we've got areas like financial setting new highs during the month of August. So the good news is that we still have some aggressive areas of the market that are still performing well, namely financials and industrials. Communication services, not nearly as bad as technology. And so there's still money that's rotating and staying in the market, which is key. Materials gaining over 1% on Friday, breaking out above recent highs. Again, here's another area where we're seeing breakouts to all-time high. Well, not all time. Well, actually, I'm not sure if that's all-time high. I don't believe it is. Let me pull up the XLB. Well, maybe it is. We'll have to look at that longer chart in just a little bit. We'll look at all the sectors on the absolute charts in just a minute. I want to go back and just see if this is the all-time. I think it is. So you got materials breaking out to all-time highs. Now, are the materials, have they been the absolute best performers in 2024? No. I mean, if you look back earlier in the year, we were up at this level. And so we're just now getting above where we were back at the beginning of April. The overall market, we've seen many areas breaking out and doing much better than materials. So I wouldn't exactly say the relative strength here is great, but the absolute breakouts are undeniable. You don't break out to all-time highs in bear markets. So it's nice to see some of these other areas finally catching up. We had all-time high one after another in technology going on for years. Well, maybe, I don't know, years might be a little bit of a stretch because of the pandemic and then battling back from that and going through the inflation and everything else, cyclical bear market. But probably since the end of 2022, we have seen that XLK just continue to climb, leading the market. Well, now we're getting some catch up from some other areas. So all those folks who didn't believe in the bull market because they said, well, we're not getting wide participation. We don't have that breadth that we need. You know, we got really bad breadth. They wouldn't believe in the market then. Now technology's taking a break and money is rotating to some of those areas. And now they want to label that as bad. It's like, well, what is good? Is anything ever good? Anytime we start talking about 52-week highs and all-time highs, unless it's in a reverse or an inverse ETF or something, that's generally going to be a good thing. So anyway, materials breaking out to a new all-time high. Great to see there. Among some of the industry groups here is a particularly weak one of late, automobiles, which was down below both the 20 and the 50-day moving average. We saw the auto index jump up almost 25 points. That was 3%, finishing at 785. That actually closed back above the 20. So what we're seeing is after the big move up in the month of August, or excuse me, in the month of July, first half of July, we saw the weakness. Then, of course, we went through the Fed meeting at the end of July and that subsequent drop that we saw to open August. And now we're back up and it's looking like sideways consolidation, not a major downtrend. And this has been one of the weaker areas. But I see the ABC kind of a drop to the downside. And now we move back up. And instead of hitting the moving averages and falling to new lows, we've actually gone through the moving averages. So I'm looking at September. I mean, I still think, you know, you've got to be aware. September is weak. Doesn't mean it goes down every year. Like I said at the beginning of the show, it's gone up 33 times that last 73 years. It's ended the month of September higher than it's began. But it's the worst of all of our calendar months in terms of how often it does that. So it's not that September can't go higher. It's just that there's obviously a tendency for September to be weaker. And it's a historical tendency that we'd all need to be aware of. I mean, if we go down in September, there are going to be some people saying, here we go, it's a bear market. I'm going to be saying, well, here we go, it's September again, because that's more often than not what we do in September. But seeing autos bounce back, get back through moving averages like we did back in middle part of August, then come back down below. Now we go back up above. It's just telling me more of a sideways consolidation kind of a story rather than an upcoming bear market. But it's not just based on the auto charts. Obviously, there are a lot of different factors that I look at when I try to call whether or not it's potential bear market or not. I just don't see it right now. I don't think we could see a down 5-7% month of September. That would be nothing. I just don't see it morphing into a bear market. In fact, I believe all of our major indices by the end of the year will be setting new all-time highs across small caps, mid caps, the S&P 500, the Dow, the NASDAQ. I would not be surprised to see them all back at all-time highs by the end of the year. Semiconductors, I mean, this is the group that leads. I mean, if there's one industry group that I would say is the most influential industry group out there, this is the group right here, semiconductors, gaining more than 2% on Friday, which was good, 390 points. But look at the action that we've seen. We saw that really deep drop back in the beginning of August. We did not get down to the lows in April in the semiconductor group, but we were getting close. It was getting a little scary there for a while. Big bounce off of it, came back up kind of into this gap resistance area, I think it was the XLK, but rolling back over again. And so finishing at 18,213, which was just a tad above that 20-day moving average. But you can see the back and forth that we've been having. I expect that to continue. I would be really surprised if the market just takes off in September and semiconductors break to all-time highs. I would be surprised on a number of fronts. Number one, I just don't think the technicals support it. And number two, I don't believe that, it would be very rare for that to happen during the month of September. So again, I think semiconductors probably, at best, I'd be happy if they just sideways consolidate and finish September somewhere between 18, 19,000. I'd be ecstatic. But my feeling is we'll probably see a little bit more weakness. This group has, come back up a little bit, but there's still a lot of work to be done. So I wouldn't be surprised if September does start to roll over again. I wouldn't be surprised to see semiconductors back down below 16,000, maybe challenging that early August low. But again, that would be if the market really started to sell off again. Electrical components, you can see rallying back above both the 20 and the 50-day moving average. Huge drop to start August relative to where they were earlier in the year. Pretty bad stuff. But this is a group that's come all the way back up and is now trading back above both the 20 and the 50-day moving average. Didn't even talk about some of the AD lines. Look at semiconductors, though. During the month of August, we didn't get to an all-time high in terms of price action, but we set a new all-time high in the AD line. That's one of those things that just tells me, okay, yeah, we're getting selling, but Wall Street's not afraid to jump in and start accumulating these stocks on weakness. And if we see that weakness again in semiconductors in September, I think from a long-term perspective, accumulation makes a lot of sense. But anyway, a little bit of a longer look at that, but I really wanted to go through and take my time going through some of the key areas of the market, because this is a critical time of the year when a lot of folks get nervous, and for good reason, because we do see a lot of downside action. So I wanted to spend a little bit more time there. Looking at the 10-year Treasury yield, check out this morning. We are now, first hour in to the bond market. We were close to where we finished on Friday at the open, but you can see now we are down almost 6 basis points on the 10-year Treasury yield. I have said before, if we do get a sustainable move through the 20-day moving average, then I could see maybe moving back up somewhere between the recent high, which is at 4%. And then you got the 50-day moving average, which we've only been above one time since June. I would think that would probably pose some problems. So I've been saying like 4.0 to 4.05 as kind of maybe an area topping if we were to continue moving up. In this case, looks like at least initially to start off September, we're rolling back over to the downside. It would be that low on August 5th down around 370 on a candle body basis, 3.70%, and maybe just a little bit below that intraday. All right, S&P 500. So here is the chart. You can see it's very close. Let me tell you how close it is. First of all, we'll zero in over here. So the high close was back on July 16th. We closed at 56.67. Friday, we closed at 56.48, 19 points away, which is roughly 1/3 of 1 point, or 1/3 of 1 percentage point away from another all-time high on the S&P, and the Dow's already hit it. So we've got areas of the market now. When I think of the Dow and I think of the S&P, I think of a little bit more value-oriented stocks, not necessarily defensive, although some of the defensive areas I think have certainly perked up of late. But I think more value-oriented, more dividend payers. So growth is just kind of taking a back seat right now, and we're seeing a little bit more strength in some of the areas that had, quite frankly, underperformed for many years. It's also September to the end of the year. Historically, outside of November can be pretty good for growth stocks. But outside of November, balance of the year favors value. It did last year. And if we go back 75 years, it does. So I would just, go with what's working. If you see that some of the areas, consumer staples or whatever, healthcare, financials, industrials, if they're breaking the new highs, why would that be any different than technology? When technology is breaking the new highs, we have no trouble trading technology stocks. It doesn't always have to be about technology. As long as technology is lagging, use the next few months as an opportunity to restructure your strategy a little bit and maybe favor some of these value stocks. Generally speaking, that normally works, at least on a relative basis, to the alternative of sticking with the growth stocks. Let's see. We'll go real quick. A couple of these others, NDX. And you can see, actually, let me just shorten the chart a little bit. That'll help too with being able to see these charts a little bit better. Let's just go last 6 months, which is what we were just looking at. NDX, you can see still a lot of work to do to get back to that mid-July high. Then we've got the IWM. Small caps have rallied back really nicely off that August 5th low, but still got some work to do. A close over 225, even though we got up to 228 at the end of July. Haven't seen a close over 225. We're not that far away. And by the way, let me give you the futures because they were down earlier, which I'm never shocked to see that in September. But let me pull up the diamonds first. Down about 0.5%. Spider down about 0.5%. QQQ down about 0.6%, and the IWM down 0.9%. So we do have the IWM right now in the pre-market showing 218.03, which is down about $2 from the close on Friday. So that would take us right back down into right about here, still well above the 20-day moving average. That short term is what I'd be looking for. If we're trending higher, truly trending higher, watch for 20-day tests to be successful. If we are rolling back over, then normally what you're going to see is breakouts above moving averages and then breakdowns below, but keeping the recent highs and lows intact as both resistance to the upside and support to the downside. So still a lot of work to do here. Right now, I'd say short-term IWM small caps looking pretty good. But if we do fail to hold that 20-day moving average, then we've got to consider, at least in the short term, that we could see some additional downside. How about the MDY, which is mid caps? And this is where on Monday of last week, we actually had gapped up. If you look back on a candle body basis, not intraday highs or closes, but just on a candle body, which includes opens. It's opens and closes. Last Monday at the open, the MDY was breaking out. Pulled back through Wednesday, and then by the end of the week, we're starting to turn back up again. A move through 570 on the MDY would be very bullish. So kind of keep that number in mind for mid caps. Finally, transports. I always like to look at the transports. And again, looking here, we got to get through that 16.3 level. I am going to stretch this out, though. Let's take a look at that 1 year on this. And then I'm going to go through the sectors real quick. So there's your overhead resistance. You can see we had the false breakout there, a couple of tails up here, false breakout. 16.2, 16.3, that area is where we need to watch to the upside. We did close back up above 16,000. So we're now back closer to the highs than the lows. Beginning of the month, we were down closer to the lows than the highs. So it's been a volatile period, but I really want to see a meaningful breakout that's confirmed, not just by 1 day, but let's get a breakout in a trend going through the upper resistance zone at that 16.23 level. That's what we really need to see. All right, let's take a quick look. I want to go through some of these sectors, and I just want you to see where they all stand on an absolute basis. I talk a lot about relative strength. It's incredibly important, especially to a trader. I mean, if you're buy and hold, as money rotates, you don't even know. You're just looking at the overall market, and it probably doesn't even doesn't worry you, or it shouldn't, unless there are a lot of other warning signs to go along with it. But I don't think that's the case right now. So as we start off, XLK, you can see down from the recent high. We topped in July and we haven't gotten back through, right? Pretty easy. How about XLY? Middle July topped, haven't gotten back through, pretty easy. XLC, July tops, but this is one I was saying didn't look so bad. I mean, we're on the verge of a breakout. We're sitting at 87.32, and the XLC's never closed above 88. That's less than 1% away. So it's communication services have hung in there pretty well. And then we start to get more value oriented. Look at the industrials. Already made the break above July and trend. I mean, these are a lot of confirmed closes above that double top and going back even earlier in March high and May high. Taking all that out, look at the PPO going straight up. Everything looks good there. How about the XLF? Same thing. Financials, I've shown multiple times now, September through December, this is the best time of the year for financials relative to the S&P 500. Now, sometimes it could be that the S&P 500 is going down and financials are just going down a little bit less. That gives you relative strength, even though you're going lower. So I'm not saying it's going to be a straight up run, but for the next 4 months, this group tends to outperform the S&P 500 by more than 4 percentage points. Or I think it was 4. I'm trying to recall, but I think it was 4 percentage points in 4 months. That's a lot of outperformance in financials. And we've got technicals to back it up right now, breaking out. So the XLF looks pretty good. Let's go to the XLV. Look at the defensive groups. XLV has kind of got a little bit of aggressiveness, like with biotechs, and then a little bit more defensiveness with like pharmas, and then the rest kind of go in between somewhere. But this is kind of the bridge between aggressive sectors and defensive sectors. And look at the XLV, more value oriented than say the XLK, XLY, breaking out new highs. Look at the XLP, consumer staples, breaking out new highs. XLU, breaking out new highs. XLRE, breaking out new highs. Part of this, folks, is that when you have when you have really low interest rates and the economy is just so, that kind of an environment tends to benefit areas that don't need, the financing. You've got technology in some of the areas that are, just absolute cash cows. So when the economy is just kind of so humming along, and these big companies are gaining market share all along, because I think, quite frankly, that some of the environment is anti-competitive. Some of these companies have gotten so big that, it could be a problem for some of them. I think probably over the next several years, you're going to see more and more of these companies being looked at for maybe, some competitive violations. And I wouldn't be surprised see some of these companies broken up, maybe not in the next year or two, but maybe over the next 5 to 10. It wouldn't surprise me, just because I do think they have a lot of competitive advantages. However, with rates coming back down, normally rates come down. Why? Because the economy is slowing. In this case, we don't quite know. It looked like at the end of July that was the case. But then August, we got a lot of really good economic reports. And so now it looks like the economy is being resilient. Rates went up because of inflation, not because of an overheating economy. Rates can move up and down for more than just one reason. A lot of people are thinking, oh, well, if rates start coming down, it's going to be like 2007 and 2000, dot-com bubble, when the economy was really weak. And so, rates were cut many times to try and spur the economy. Well, if the rates are coming down, if the economy is already okay and rates are coming down because inflation is now in check, completely different animal. So if rates are simply coming down and we have no more inflation, that's a good thing for real estate. I mean, I think it is anyway. If you're an owner, if you got your building, financed, commercial building, you can go back and you can refinance at lower rates somewhere down the road. You can buy new buildings if rates come down. It makes them more affordable. So there are a lot of reasons why these other groups are performing well now. And I think it's temporary, but it's nice to see these other groups breaking out to all-time highs because they lagged for so long. Anyway, two groups I don't follow as closely because I don't really think they're tied. I don't consider them aggressive or defensive. They move a lot more based on, in the case of materials, you got commodity prices, energy, of course, you got crude oil, and geopolitical events from around the world. and OPEC, whether they decide to produce more or less oil. I mean, there's all kinds of different factors that go in that really, it's not based off of our economy. So I look at XLE and XLB, I just call them neutral sectors because I don't really put them in one category, offensive or defensive. They just kind of move on their own from time to time. The dollar impacts, what's the dollar doing? Because the dollar impacts gold and silver and maybe copper to a lesser degree. So you got a lot of other factors that come into these two groups. But anyway, energy definitely lagging. We've got, support down in the 86, 87 range. Resistance, you got triple top now up at about 94. So that's probably the range I'd look at there. XLB, I just told you, just broke out to an all-time high and now is trading down a little bit today, back down below that. But overall, I mean, I love to see this breakout. The more and more companies that are in all-time high territory, the better it is for the market. Everybody said that when it was only the Mag 7 carrying the market higher. They're like, oh, no, you can't trust this market because everything else isn't performing well. Well, now everything else is performing well, and we still have people out there trying to say the market can't go higher because now semiconductors aren't performing well. And by the way, now we got defensive groups that have broken out to all-time highs. That's bad news. It's much like interest rates. When interest rates are going up, I remember back in 2022 when the Fed started raising rates and I said the market was bottoming, people thought I was crazy. And I was getting some pretty nasty comments on YouTube videos and on I was getting some emails and so forth. How can the market go up? Don't fight the Fed. Well, you saw what happened. We fought the Fed and we won. The stock market won, I should say. Stock market bottomed in 2022 at the front end of when all those rate hikes started. Now we got people coming out and say, well, when the rates are going down, that's bad for the market. So you got people saying everything's bad for the market because bad news sells. People don't do research. They just throw out whatever kind of makes sense. And, if they believe inside themselves that the market's going to go lower, they'll find anything they can find to talk about why the market's going lower. I'll tell you, historically, September, not a great month. So the bears have that going for them. But it's not every September. We got the presidential election coming up. Presidential election, historically, August, September, early October, first half of October, not so good. I'll be honest. And it may not be this year. We might have a pullback because of it. It's very possible. But when we get through all this period, I'm telling you, when you get rates dropping and you don't even have an economy that's telling you to lower rates. I mean, maybe there's a few out there. I mean, we saw initial jobless claims for a while going up, and we saw unemployment moving up. And by the way, we've got the non-farm payrolls coming out this Friday. So even though it's a holiday shortened week, we do have a couple of really big economic reports. We've got the ADP report coming out. I think it's on Thursday. I think they move it back a day when there's a holiday on the Monday. But double check me on that. Initial jobless claims, which spooked, I think, a lot of investors a month ago, all of a sudden doing much better, coming back down. So you got to watch that on Thursday, make sure there's no big surprise there. And of course, the unemployment rate on Friday is something I think a lot of folks are going to look at. And if initial jobless claims coming down is any indication, I would expect that 4.3% unemployment rate this Friday maybe to tick back down, 4.2, 4.1. Wouldn't be surprised. So, yeah, I mean, that's where we're sitting as we start the month of September. It's not a good month historically. I'm not going to sugarcoat that. We could pull back, but I really believe if we pull back in September and early October, it is going to be a tremendous opportunity because I do think as rates come down, especially areas like the small and mid caps, financials, industrials, I think all of those areas, many of the cyclical areas are going to do really well with the rates coming back down. Anyway, that's my thought. Let's take a look at what's happening so far in the market. Yeah, we got some weakness here. We got the Dow down 0.5%, S&P 0.75%, NASDAQ down 1%. Small caps now down 0.7%. So on a relative basis, it looks like maybe the small cap's doing a little bit better. The VIX popping. I'm going to talk about the VIX for 1 second before we go, because I've had folks write in and say, well, your VIX theory didn't work. And I'm just thinking, why didn't it work? It's not for those of you who may be scratching your head wondering what I'm talking about, bear markets, I've studied bear markets. I've studied wannabe bear markets. It didn't quite become bear markets, maybe corrections. I've gone back to 1950 and I've studied all of them. And then we have the VIX, which we started tracking back in the early 1990s. I think it was 1990, 91, something like that. But the VIX tracks essentially the price of short-term options, short-term S&P options. And as the spread or as the premium increases on these options, it's market makers basically pricing in the likelihood of increased volatility. And if you know anything about the volatility index, when the volatility index goes up, market usually goes down. The only time in history that I'm aware of that was not the case for an extended period of time was back in the late 1990s, when it was extremely volatile. I mean, the NASDAQ went up 83% that year, I think. But it was volatile in both directions, mostly to the upside. So the VIX rose back then. But outside of that, when the VIX rises, generally it's the market declining. So when we get a VIX that goes through 20, I've said it many times, when VIX goes through 20, I try to avoid risk, which many times will mean I go to cash. Take no chances. And that's what happened when I issued the warning on the Thursday after the Fed meeting, right before the IWM, or right in the middle of the IWM, dropping like 15% in 3 days. So, you get some warnings from the VIX. You got to be careful. But the point that I made was that we've never had a bear market where during the bear market, the VIX goes back down below 16.5. So in other words, even if you thought the beginning of August was the start of a bear market, when the VIX came back down below 16.5 and traded back down into the 14s, we have never seen the market continue the decline and become a bear market. It's kind of like you see a hurricane in the Atlantic, just forming, and it starts trekking, and then all of a sudden it turns north. How many times have you seen a hurricane go north and then come back down south? It doesn't happen. That's not the way hurricanes form. It's not the way they track. Same thing for bear markets. Bear markets require a certain level of fear. When you get a VIX that goes down below 16.5, that fear is going away. And once it gets down to a certain level, we've never in the history gone on within that same downtrend to become a bear market. In other words, to fall 20%. So, I mean, the Dow has already broken to an all-time high. So already the Dow, you can forget that one. That's out of the equation, because now if we get a bear market, it's starting from now. It's not starting from a month and a half ago, because you don't have all-time highs come in during a bear market. So even if you thought the Dow was in a bear market, it's not now. S&P is close. I mean, if it breaks to an all-time high, then the chances of a bear market starting back in in July has ended. You got an all-time high. So all of that's gone. You're starting over now. The bear market would start as of the time that you get to an all-time high. Anyway, some people, when the VIX went down to 14, when it goes back up to 17 or 18, they're like, see, you're wrong. The VIX did move back up. That's not my point. The VIX could go back up to 20. It could go back up to 30. What I'm saying is that the likelihood that the decline that started back in July, the likelihood that morphs into a 20% decline based on history is zero. It's never happened. Could it happen? Sure. Anything can happen. It might be the first time. I'm just pulling out history. I've done research. When you get the VIX down below 16.5, 17, in the midst of a decline, which we're still in, technically, S&P hasn't broken out to a new all-time high. So we're still in a decline. In that kind of an environment, the VIX never goes below 16.5 during the bear market. So the VIX signal would be wrong if the S&P now in September and October morphs into a bear market and we go down 20%. Then we could say, for the first time ever during the bear market, the VIX went down below 16.5, and we then later went on to have a bear market. That's all that was saying. So it's not what the VIX does from here. It's what the S&P 500 does from here. Anyway, I had a few questions on that, so I wanted to clarify that. Anyhow, listen, everybody have a great rest of your day. Enjoy the week. Again, non-farm payroll is coming out on Friday, and it is the start of September. So be careful out there. Happy trading, everybody.